So in the UK with the pension system and what happened when the gilts collapsed, I mean, it's because you have these pension funds that they need to create a certain amount of return over the life of their investment fund, which is in perpetuity, in order to pay out these liabilities that they have. They have to pay out their pensioners, right? And who are the members of that fund or schemes, as they call them in the UK, even though that's kind of a negative connotation here in the United States. They're called pension schemes out there. Well, the problem is that when you have interest rates manipulated so low for so long, I mean, you had a very difficult time in Europe trying to find yield. There were $15 trillion of negative yielding bonds. This is nominal, negative yielding bonds last September. So, I mean, trying to figure out a way to make enough money to pay out those future liabilities is an issue, right? So what happens is the pension funds have to figure out a different way to do it. And so enter the LDIs, which are liability-driven instruments or investments. And so and what they are is they're just swaps, right? And so there's nothing inherently wrong with a swap. You can use a swap to create returns and to minimize risk, right? And we'll get to the third way to use them, but creating returns, and with a swap, because you can swap out, what you have on your books in order to make an investment in wherever the way you need to make it, right? So, but to minimize risk, you can swap out floating interest rate instruments or securities into something that's fixed, so you can have a predictable cash flow. You can swap out currencies. So if you have some sort of investment that is not in your base currency, that you can swap that into it, so you don't have that currency risk over the life of that investment. But then you can also use them to leverage. And this is exactly what they did in the UK. And so they would use these instruments or these investments, LDIs, in order to lever up the returns they were getting, because if they were getting just a few percent, they could lever that up 2, 3, 4 times that in order to make a better return, right? So if you're making 3%, you can lever that up to 9% or something, right? 3 times or whatever it is. I mean, when I was doing swaps back in my arbitrage days, I only had to put down 5 to 8% collateral on our swaps. And so think about that. I mean, that's like 20 to 1, right? That's a lot of leverage for that investment. Well, these guys are doing this in their books, and then the new the finance minister, right?
Kwasi Kwarteng.
He came out and said that he was going to have this massive tax cut, right? Didn't tell anybody where the money was going to come from, and just said, we're just going to have this massive tax cut.
And increased spending.
And the market literally imploded. Like, it was like, whoa. And so anybody who owned gilts, the UK bonds, they were like, where's the money going to come from? This introduces, this is going to be a problem. This is going to be negative real rates for as far as we can see now. And so they started selling these bonds off. Well, they started selling them down, and the UK investors, these pension funds who had these LDIs, well, remember that if you have something that's on leverage, you have a margin requirement. And these started dropping down and getting close to the margin requirements, and they were going so fast that some of the pensions were now underwater in their investments. So they approached the Bank of England. They were like, if you don't stop this, we're done. We're all insolvent this afternoon. And so, I mean, and again, it goes back to what you were saying, reaching for yield. And that's the problem. And this is the fiat disease that you're talking about. Exactly.
Well, this is the interesting thing. I don't have a pension. The reason I don't have a pension is when I got divorced, I had to split my pension. And I went to a pension advisor, and they said to me, like, how much money do you want to live on a year?
What would you have had a pension from?
Well, I had... just from my company, I had an advertising agency. So I used to put a certain amount each month, and you could match that tax-free with the government, like, incentivized it tax-free. Yeah. It wasn't a great pension, but anyway, I went to a pension. I only did it because my business partner said to do it. Yeah. But I went to my pension advisor and financial advisor, and they said, how much do you want when you retire to live on? You'll have a lump sum, but how much do you want to live on? I was like, I don't know. I mean, 40, 50 grand a year would be great, a decent amount of money. And they said, okay, you need a pension pot of 2.2 million. I was like, huh? You what? They said, yeah, so you need to save 2.2 million for the rest of your thing. And we were talking, I was like 35 at the time, 45. So
that was their projection. Yeah,
so I was going to work 30 years.
Yeah.
So I'd have to, even if I earn 100,000 a year, I couldn't do it. Mm-hmm. So it's like, I'm just not going to have a pension. So what I'm going to do is I'm just going to earn as much money as I can, and I'll work until I have to work. That's just going to be my life. And if I work till 70, so that would be it. Obviously, the thing I've discovered now with Bitcoin is you look at this and you go, this fiat disease is that if you want a pension, you've got to constantly be chasing the inflation number and beating it out, performing it.
That's right.
The great thing about Bitcoin is you kind of with the deflationary currency, you just have to have savings. And if you're saving in something that is deflationary over 40 years, by the time you retire, you've got your nest egg, you're good.
You're good.
And you haven't had to do anything. You haven't had to steal from anyone. You haven't had to lie to anyone. You haven't had to fucking anyone over. And like these little pins keep dropping.
Yeah. Exactly. That's exactly right.
Yeah.
That's it.
Well, anyway, so back to, I don't know, we got there from Mr. Bankrupt Fraud, but...
Reaching for yield.
Oh, well, interestingly, it's a coincidental number. Your price target is now 2.2 million. Interesting. It's my pension number.
Isn't that?
I would have just needed one Bitcoin.
Now, are you referring to a tweet I sent out that, that was half in jest because, the value of Bitcoin has actually gone up. The price of Bitcoin's gone in the other direction for various reasons, but the price has gone up. I increased it by 10% because I view that as being the positive contribution by getting rid of some of the shitcoinery that's going on within this asset class. But I've run through that number with you before, Peter. How I get to 2 million. It's pretty simple. Grade 11 math. We could run through it if you want, but the reality is I sent that out by trying to make a point that the value of Bitcoin, with all these things that have gone on, macro events within the TradFi world, micro events within the crypto ecosystem, all have led me to believe my valuation for Bitcoin is higher. And why is that? Well, because the likelihood of you needing the insurance against the system has increased. Meaning, with all the mistakes the LDI, the pension plans are making, you need to have insurance that there's some other asset there that's going to protect you.
But we're not really at that point where Bitcoin is reacting.
Not yet, because it's education, but also there's still a lot of levered money on Wall Street that is trading Bitcoin as a risk asset, when in fact, it's going to take a lot of education to teach the hot money, let's call it what it is, it's hot money, to understand that Bitcoin is a non-correlated asset that actually is insurance, which means it shouldn't be traded as a risk asset. It's actually the flip side. As risk increases, which it is in the world, Bitcoin becomes more valuable, not less valuable. That hasn't permeated the thinking process on Wall Street yet. Why? Well, they don't teach it to you in school. When you come out of an Ivy League school, and you're working on Wall Street, perhaps some of the things you were doing to begin with is writing an algorithm to discover a correlation between Bitcoin and NASDAQ stocks. And historically, it has reacted like this, so the algorithm will program it to continue to act that way until further notice. It takes a lot to break down these bad models.
What's your time scale? Sorry.
Yeah. Well, here's the key. 2.2 million in today's dollars. So I have an expression, give a target, but not a time. Well, we're measuring it in today's dollars. So if it takes 20 years to get there, what is the value of today's dollars?
Oh, you think it's worth it now?
I can give you the math that indicates to me that it should be trading there. But it's only here. I'm going to flip it on its. Well, I'm going to flip it on its ear. I'm a probabilities guy, okay? And I'm never 100% certain of my investment outlooks, but what I do try and measure is what the market says my odds are, Peter. Yep. So you take, and it made the math easy when it was $20,000 versus a $2 million price target. 20,000, and it's in today's dollars, versus 2 million. You take today's price target, you divide it, trading price, you divide it by your target, and you get a percentage of what the market says your odds are. That's a 1% chance. The market is telling me I have a 1% chance of being right. And I'm not saying I'm 100% certain I'm right, but I'm way higher than 1%, ladies and gentlemen. And that's how I've always managed risk my entire career.
Right. And for anybody who is watching this and saying, yeah, but you've got to put an interest rate on that for, to discount it, we're at negative real rates.
Okay,
so
that's
it
fair,
really
but
matter.
I also stress
saying,
it is today's dollars. Let's not mess.
So what I'm saying is it doesn't matter because we're at negative real rates. So it's even better than that.
Because the interest rates are lower than inflation.
Yeah.
Correct.
Yeah. So it's even better than that.
But again, bring it down to first principles, Jeff Booth thinking. It's like going to the racetrack this year for the Kentucky Derby, and you had watched the Kentucky Derby winner train all the time. And you know what the odds were going into the Kentucky Derby of that horse winning Kentucky? 80-1. And that's where the odds closed. And if the guy who had spent his life studying horses had watched this horse train, he's like, okay, 80-1 is a long shot. And I still don't think he's a lock to win it. But man, the odds aren't 80-1. Maybe they're 25-1. So that's why you have to take opportunity of wrong odds that are laid by a racetrack or by a market. All the same thing comes down to risk management.
Yeah, and we did the same thing in arbitrage. You'd look at whether a deal was going to close, and you would handicap it. And if the market said it was like a 30% or a 40% or a 50%, and you thought, God, they're either I'm missing something or they're out of whack on their price, and that's where you would take if it's a compelling opportunity. And that risk reward is so great. Then
I, again, it's James's show, but I can't keep my mouth.
It's our show.
It's our show. Hey, asymmetric investments define careers. Right. Okay, that's as simple as it is. I've had 3 in my life, asymmetric investment opportunities. This is hands down the best I've ever seen. It's not even close. The other 2, which were the best up until my, my current introduction to Bitcoin, they were good, but the asymmetry of Bitcoin is just so beautiful. Hands down, this is the best opportunity I've ever seen.
Agreed.
Yeah. I think it's I missed the internet one and I should have taken it.
Coulda, woulda, shoulda.
Yeah.
That was uncertainty. But, if you had zero exposure, you were also on the wrong side of that trade, right? But this is how you line it up. And mine came out of the second one came out of the great financial crisis. And, the asymmetry was just crazy. And there was so much of this available. I was able to buy $7 billion of something for our fund that's why I hung up my cap at the end of the great financial crisis and, 4 years later, because I said, I'll never be able to recreate that opportunity. Yeah. And guess what? In 2016, I found Bitcoin, but I wasn't managing money professionally anymore, except for my own account. And that's why I've gone in with both feet. So lucky to meet a guy that speaks the same language as I do. Because that's all it is. Managing risk is managing probabilities. It's managing an expected value outcome. And that's what I take such exception with these knuckleheads on Wall Street who say, it's got no value. Okay, are you 100% certain of that? And they'll say no. And I'll say, then shut the F up because you have to play probability distributions. That's where you're dealing with the fiat mindset versus the reality of managing risk.
And really the challenge is to get some of these institutional investors to leg into the trade, get some, so it forces you to do the work and forces you to do the real research on it. And then they'll be orange pilled if they really truly do.
What about your old buddies on Wall Street? Have you talked to them much about this?
A few, and I've got 1 or 2 that understand it. Like literally a handful.
They already did, or you spent some time with them?
No, they already did. But beyond that, I mean, they're just they group it up with Ethereum and Web3 protocols, and they're like, they just don't understand how it's different. They think it's all crypto, and I'm just getting a little bit of each, and we're trying to, they don't understand it, and they haven't done the work on it. They're mentally lazy,
intellectually lazy.
It's correct. Intellectually lazy. And it's incredible. And there's going to be a lot of them that miss the boat, absolutely miss the boat.
Can I add? So the cool thing is the one guy that was one of my biggest counterparty traders in this first, coming out of the great financial crisis, he was a JP Morgan trader. He just messaged me yesterday on LinkedIn because he's been following it. He does not want Bitcoin to succeed, but his spider senses are indicating.
Kicking in.
Well, he's like, hey, Foss, let's talk more about this. And I'm like, fine. I'll go into anybody's barn and have a discussion, whether they're crypto, whether they're fiat based, because it's an education process. And there's a lot of people that are paid not to want it to succeed. Okay. But there's enough smart Wall Streeters who know they have to cover their ass as well from a risk management perspective.
Well, I tell you what's been interesting on this cycle is the previous cycle, it was very much the kind of like the Bitcoin educators, it was the writers, it was the techies. This entire later cycle has been dominated by macro people. I mean, we have you, James, we have you, Greg, we have Lynn, we have Preston, we have Luke Woman. I mean, Jeff Snyder now, Larry Lepard. And even though Jeff Snyder isn't a Bitcoiner, he kind of is and doesn't know.
No, he doesn't realize it.
He doesn't realize with the years.
Yeah.
I mean, same, we've got so many now. And, our show isn't a Bitcoin show anymore. It's a macro show. And the reason I can tell you that is I can make a show with Lynn Alden. We can not even talk about Bitcoin, not even have it in the title. It would be the biggest show of that month.
Isn't that interesting?
Yeah, this one will be a big show. People want macro. They want to understand money. They want to understand the wider context.
Yep.
Of course, they want some Bitcoin stuff as well. But the macro people have driven the engagement and the interest of this cycle, and there's more of them coming, and they're smart, and they're coming out with great arguments.
And the 60-40 portfolio, which is the traditional 60% equities, 40% bonds, has been decimated this last year. It's the first time in 100 years that both strategies have been down double digits, okay? And that means that there are asset allocators out there that need to find new ways of meeting their bogey, which if you're a pension plan and you're assuming you have a 7% hurdle rate and you just lost double digits negative combined, you need to find something that's going to bring that return up or diversify your investment portfolio. So it's happening. Fidelity is the leader on the institutional side this way. And look, BlackRock is doing it, kicking and screaming. Larry Fink didn't want to do it until he realizes he's losing clients to Fidelity unless he does it.
Or opens it up to the individual investors are the ones who are clamoring for it. They want this. And so now they have to listen to it. But we talked about this the other day, and there are 5 institutions that control $30 trillion of assets in this world. You've got Fidelity, Vanguard, BlackRock, State Street, and UBS that control $30 trillion. So when they get in and they actually put it in their portfolios, it becomes a no-brainer for other asset managers to do it as well. I mean, that leads them to do it. But again, going back to our original point, which was we need some regulation in here to get them comfort to understand how Bitcoin is different, because the regulators are going to tell them Bitcoin is different, and they'll go, oh, okay, and it'll click finally, and they'll say the career risk has been, it's been taken down, and so I can now leg in, and they get in a 1, 2, 3% position. What's the math on that, right?
It adds up quickly.
It adds up quickly.
Yeah.